Hi there! If you are tuning into this podcast, it means one of two things. Either you have no clue about managing your finances or you want to take them to the next level. Either way, we've got you covered. Financially Ever After is for the modern day Indian professional who is ready to take control of their financial journey. So let's start building your financial future one episode at a time. Welcome to Financially Ever After. Today, we have a great group of people who are joining us in this conversation to talk about personal finances from an engineer's perspective. The format of the show is that there's a Q&A with the panel for the first 15-20 minutes, and then the audience, you guys get to jump in and talk to us. So whether you have questions or just thoughts that you'd like to share in, happy to have you join us. You just have to raise your hand, and Ankit will let you into the conversation, and then you can introduce yourself and ask your question or share your thought. So from starting your first job to actually retiring, we're going to be talking about a whole host of financial topics, and hopefully after the end of the conversation today, you'll be a little bit better prepared to take control of your finances and possibly secure your financial future. With that, let me introduce our guests for today. The first guest is Gaurav. Gaurav is a serial entrepreneur. He's a 3 times TEDx speaker. He's a passionate cook. He's also a cat parent. Gaurav is really curious to know about a lot of different things. He has his own podcast, so you can check it out. It's called Behind the Success with Gaurav Sharma. Another cool thing about Gaurav is that he's also known as the trash man of Rajasthan because of his work that he's done in waste management, and he's also 40 under 40 recognized by Rajasthan Patrika. So hi Gaurav, nice to have you here.
Hello, thank you very much. Happy to be here.
Hi. Next we have Harsh Bhare. Harsh is a product manager by profession and a mechanical engineer by education. That is, I think, a lot of people who start off in engineering and then end up doing something else. He has 7 years of experience across social media, e-commerce, and startup incubation. He has worked in both B2C and B2B industries, and primarily with startup. How I know Harsh and Gaurav is because we were all part of this international organization called ISEC. So it's lovely to have my ISEC connects back here. Hi Harsh, how are you?
Hello. Hi Neda, Ankit. Thanks for having me here. Super happy, super excited. Looking forward to the conversation ahead.
Perfect. Thanks, Harsh. Super excited to have you too. Next, we have Dr. Harshit Agrawal. He's a mining professional with over 10 years of experience. He holds a PhD in mining from Imperial College London, and he works as a subject matter expert. He's currently working at Accenture in London. So firstly, thank you for joining us. I know it's still work hours there, so for taking time out to do this. He's also a visiting researcher at Imperial College. And, Harshit, I hope, you can hear us, and thank you so much for joining us.
Thank you very much. I hope you can hear me fine.
Yeah, I can hear you. Thanks. And next we have Bharg. Bharg is joining us from the US, which is super early morning for him. So thank you again, Bharg, for joining us super early in the morning. Bharg did his BTech from IIT Gandhinagar, and he's currently pursuing his master's in robotics at UPenn, and he's going to be a robotics engineer at Johnson & Johnson soon. So hi Bharg, how are you?
Hi Mera, thanks for having me, and I am doing pretty good and looking forward to it.
Thanks Bharg. And finally Ankit. Ankit is the host of this event. He's the founder of Wealth Up. He graduated as a chemical engineer from BITS Pilani, but he found his passion in finance, again very similar to Harsh. He worked with Swiss Bank UBS in New York and PwC in Bangalore, and Ankit is of course the host of this show, but he also posts regularly about personal finances on LinkedIn. So hi Ankit.
Hi Meeta, hi everyone.
Awesome. So one thing that I'll request from all of the guests is that if you could keep giving your reaction so that we know what you're feeling, and whether you are agreeing to what people are talking about or you're disagreeing, and that will be really great. At some point we will get you to join in on the conversation as well. So without further ado, let's get started. So I actually want to start this entire conversation by putting the spotlight on Bharg. Bharg, since you're at the beginning of your sort of career, I want to ask you, what is it that comes to your mind when you think about finances? So let's say, we have some people in the audience who are just starting their career, or, engineers who are at the beginning of their career. So, what is some question that you are talking about or is relevant to you?
So the first thing is like me and a lot of my friends have this conversation. Is like once like I start working, I'll have some income. So one thing that we get it from our culture is like save for the future. But one more thing, a recent thought that has come up after the pandemic is like live your life to the fullest, enjoy the present, and that way don't like focus too much on saving at the moment. So I would like to know like what is like a good balance between saving and like spending it on yourself. So like how should I manage my finance?
Okay, Ankit, do you want to take that one?
Sure. So, thanks, Bharg. See, as you mentioned about balance, so it is all about balance. Lately I have been seeing people, influencers, posting something like growing up they were very poor and they always wanted an AC or take their parents abroad because they have never traveled abroad, or something of that situation. So they made these expenses as soon as they started earning. Now let's take an example. Suppose there's a trip that you want to make, and say it's going to cost you 1 lakh, and you save 50,000 every month after all your expenses, basic expenses, partying, shopping, everything. So there can be three approaches, right? First is you make the expense on the first month itself. You book the trip, you pay it by credit card, and once you get the first month salary, you pay part of it, and then you pay the rest of it once you get your second salary. Second is you wait for 2 months. As soon as the savings are done, you have that 1 lakh rupees, you use that and you book the trip. And the third option is you save this 50,000 rupees that you're saving, you divide it in two buckets. One is for this trip, and the second one is for your emergency fund, investments, long term, whatever you may think about. And in 2 months time, in 4 months time, when you have these this 1 lakh rupees to invest on the trip, that is when you book it. Now when you started, but when you start working, it is going to be a first job, so it's totally fine even if you're say not saving for say first 3 months or even 6 months. It's totally cool ki, you want to enjoy life, and there are so many things that you might have been thinking that you would do, but as students there is a limited pocket money or income that we have, so it's totally fine if you sort of spend all your money for first 3 months or 6 months. But after that, it is important that you start maintaining a balance between enjoying today and also saving for the future. I hope that answers the question.
Yeah, it definitely does. And yeah, I think that like splitting up into two buckets with the aim of spending it like one of the bucket towards like a goal seems to be like a legitimate way to go ahead.
So yeah, absolutely, because it shouldn't be the case that you're saving every penny of what you're earning, and you're not enjoying your life, right? It's important to enjoy life. So those rewards should be given to yourself.
So I have a question for like the others as well, right? Harsh and Gaurav. Like when you started working, when was it that you started actually investing or thinking about saving? Was it immediately or did you wait a little bit?
I can go first. I think when Bharg was asking the question and while Ankit was answering it, I think it was a very common situation that everyone is in. That I think initially, obviously, since we are from an education perspective also so less exposed to financial literacy, that until and unless anyway you have some money, you wouldn't know what to do with it. So for me, it definitely happened that I waited for about a year and a half. Once I think I had enough liquidity and spent some money on some basic things that I always wanted. I think I started after that, right? So, and then I do feel sometimes that maybe I started a bit late, but I don't know.
What about you, Gaurav?
I believe being an entrepreneur rather is a very different journey, and especially let's say if you're in tier 2 or tier 3 cities, a lot of conversations are missing out in terms of let's say the kind of people you hang out with. Maybe a lot of intellectual conversations are missing in smaller towns. So I believe that is where this becomes very crucial. For me, I would say it has happened last year and a half rather. So when I was just moving towards my 30s, and that's how I would say when it happened. Maybe because there are a lot of things you are trying to figure out, and maybe investments or financial viability is not one of them at times. Because when you're building something out of scratch, I mean, it takes a lot different things as priority. So I would say, so that is what and how it has been for me.
Yeah, no, that makes sense, Gaurav. I mean, we've been talking about salaried professionals, but of course, if you're going to be an entrepreneur, that's a whole different journey. So, you started with entrepreneurship immediately after graduating?
So I worked only for 5 months, and just after that I left it. So eventually I did not had any savings, right? So my journey has been little different from that angle. But yeah, I mean that's what I'm saying. So when you're building something with zero understanding or with zero experience, it is a altogether different journey, because you're trying to figure out your own resources. You're trying to figure out your own venture. You want to bring profitability in the venture itself. So as a founder, you prefer not taking any salaries out and all of that, or maybe even if you take, it's a little cost. And plus, I was living in a city where I was all by myself, so it adds a lot of other costs in terms of living as well. So I believe that is where, for someone like me, or the profile, or the kind of journey I had, it's a very different path. And maybe I still believe that maybe I could have went on the journey of budgeting my life, my daily expenses or monthly expenses, could have been a very different journey altogether in terms of starting my investments early.
Yeah, no, absolutely. And I think that's where people miss out as well. So, Harsh, you mentioned that, 1.5 year into your job is when you started with kind of investing. So, how did you kind of do that? So, Ankit is talking about balance. So, what was the challenge that you faced at that point?
I think you actually what happens is, as I was telling you, that there is almost when you're starting to earn and when you're in your first initial months, you actually don't know what to do with it, right? Like, so you have to build that entire uh, knowledge base, trying to understand what exactly is financial planning, what exactly is investments. And I think funnily at that time, even I didn't know, why I was getting charged the income tax I was getting charged, right? So it was from that fundamental level that the understanding seems missing. But then slowly, steadily, started with following. At that time, there were not so many people who were talking about finance. So there were a few of them, and I think that helped at that time. Trying to read blogs, watch videos. I think that was some of the things I started doing, and then uh, luckily, while I was working in my first company, I actually partnered with one of the popular apps these days. And then, while I was actually promoting it in the internal company, I also, said, why don't I also try it out? So my first interaction with financial investment was actually through an app. But that also because I was supposed to do a partnership with them, and I was supposed to promote them in my network. So I tried it out as like a product test kind of a thing, and then I started learning.
Okay.
But then as things grew, today I just feel like there's too much to understand from, right? Like now that I am at this stage right now, every day some or the other new instrument comes up, right? There's mutual funds, there's equity, there's debt, there's stock market, then there's gold, then there's bonds, and then bonds, there are government bonds, private bonds, future and options. I mean, so many things come up. I just feel at certain point of time there is too much out there, right? And everyone would say, okay, here is a tool, use it, and you're sorted for life. So I feel there is a lot of pressure in there to do everything yourself, and if and one of the fear that comes with it is what if you don't get it right? Because as you grow your investments, they also start accumulating, right? And then if it is not very risk adjusted, it can be bad for you. So I feel that particular point, is something that actually I felt is a challenge as you start growing your investments.
Yeah. So, what about?
Yeah, so adding to Harsh's point, he used a lot of terms. So what I think is how much is the extent of financial literacy should we have at this point? And because there is like a certain amount of time that we can spend either on our profession that we are focusing on, or maybe the financial literacy. So like if you could share like what is the extent of financial literacy at a basic level one should have?
That's a good question. Ankit, what do you think?
Yeah, that is a very good question. So, first of all, Bharg, everyone should have some basic level of financial literacy, and this is sort of the need of the hour. And to do this, either you can talk to someone who is sort of a few years ahead of you. Generally speaking, talking to someone from a previous generation would not help much, because their point of view is going to be very different, because world and financial markets have evolved a lot in last, I don't know, like 20-30 years. India as a country has evolved a lot. And or either, so you can talk to someone who's sort of a few years ahead of you, some senior who's good with finances, someone you respect, or you can access a good source online that you trust. Okay, try to learn about a few things, because there's also limitation on how much you can do that, as Bharg, you pointed out. And so Medha and I also keep posting about finance, so you can definitely follow us too. But when it comes to major financial decision making, it should you should be talking to an expert. So it should be something like you can relate it to like say you have a minor headache. Okay, that okay, you can probably take a medicine. You know which medicine to take. But when you have a bigger problem, you don't spend time just googling stuff, or how you can operate on yourself. Similarly, so in that case, you'll be seeing a doctor, and that one expert. Now, similarly, it's like when you have some small little items from the financial perspective that you need to take care of, and to your point too, initially you can manage it on your own. Basic things. There should be some amount of money with you. You should have an emergency fund, and when you think, okay, now I'm not able to do this, and don't do some hidden trial. Okay, let's try this, let's try that, because as Harsh, you were saying, there's so many instruments out there. Start with basics. Okay, understand what makes sense for you, because there are so many options out there. Start with the basics. Start with a few instruments, few basic things that you are aware of. Just putting some money in your bank account, small amount of money in your fixed deposit, and when you have few things of these sorted, that is when you can start exploring more, and just see who is it that you can learn from. There are so many resources. Just see which one is trustworthy, because many a times a lot of people talk about stuff when when their knowledge is kind of superficial, and it may or may not be relevant to you.
Thanks for that, Ankit. Does that answer your question, Bharg?
Yeah, definitely it does answer my question.
Awesome.
And
I
yeah,
have a
I think
question there.
I have
Sorry.
a better.
Sorry.
Yeah, Harshit, please go ahead.
Yeah. So as you mentioned, like trusted sources online. So how would you identify if it's a trusted source? Because many a time I see several influencers saying something today, and then once the market goes down, then they will just change their whole narrative. So how can you be sure that the person you are trusting is actually a trusted person?
Actually, Harshit, that's again a big problem, and because many a times what happens is people think that okay, this XYZ influencer has 5 million followers or something, and so he must be pretty good. People follow that, and what you have just mentioned, that's a common problem that's happening. But when you're following someone, one thing that you can do is to look at their own credentials. When they are talking about anything, any idea, any product, if they're talking about any product, first thing that you need to see is that is it co-branded? Is it being promoted? If they're actually asking you to go and buy it from XYZ platform, something like that, then you need to be careful, very careful, because they are getting paid a lot to just say that. Secondly, if they are talking about anything, any financial product, don't just take their word for granted. Do your own research. Okay, and when you when you Google, go for websites which are very trusted, international companies, or even Indian companies, Indian websites which have established their brand, because they will be very careful in what they are publishing. They will not be the ones who will go back and forth on their word. I hope that answers your question,
That makes
Harshit.
sense. Yep, that makes sense.
Okay, so I want to ask Gaurav, right? Because you mentioned that you were an entrepreneur in the beginning and you wish you had kind of started earlier. So, did you ever consider getting advice from someone, or ever thought about कि इस maybe experts होते I can talk to them? And by the way, Gaurav, at that time, which city were you in? Were you in a tier 1 city or tier 2?
No, I was in Jaipur.
Okay.
So I went to work in Delhi for 5 months, and then again I moved back to Jaipur because I had a lot of resources and network back in the city, and I felt that when you're starting a venture, the cost goes down if you're starting from a smaller city as compared to the bigger one, and that's how it happened. I would say, yeah, definitely, I was aware in terms of that. I mean, you should always reach out to relevant people in order to seek the guidance whenever needed. So I believe one thing which was missing was that when let's say the fund is little, right? So a lot of times, let's say, and I'm saying this for a lot of entrepreneurs who are just in the journey or maybe a year or two within the journey. So let's say when you're taking a salary of 40,000, 20,000, 30,000, whatever it is, and I'm saying especially below 50,000, the trouble comes is that you personally feel that the amount is so small to be invested.
Yeah.
And I believe that is where, I mean, let's say the law of computation and all of that that goes missing. So I would say my question would be here directly on the similar lines that let's say someone who's barely making, let's say, 30,000 or 40,000 a month, and what would be 1, 2, 3 actionable items for those individuals in terms of investing. And especially, again, I would again put another filter that maybe these guys are in terms of age group of 23 to 25, where their focus is also, let's say, to live their life and to build their life simultaneously.
Yeah. Good point, Gaurav.
Yeah, very good point. So, Gaurav, generally speaking, I'm sure you must have come across these rules 40, 30, 20, and 40, 40, 20, 40, 30, 30, and 50, 30, 20, and a number of those. See, when you're starting, and even when you're earning when your income is let's just say 20, 30,000, 40,000. One thing that you should definitely get into a habit of is saving. Ideally, minimum 20%, but particularly when you are, your income is on the sort of, on the lower end, 20, 30,000, 40,000. It may be difficult, but you should try to save, some portion. Decide what that number will be and be, disciplined about it. That number, even if you're saving, say 5,000 rupees, that number may not appear as much, but when you start saving that, I'm talking about saving, not investing as of now. So when you're saving that number, you're getting in the habit. It is not the case that you're just blowing off all the money that you're getting. So saving that money, just getting in that habit, and just putting that money aside. So maybe have 2 bank accounts. So you're just putting this money aside so that you don't see that money. And as humans, you must have heard out of sight, out of mind. So when this money is out of your sight in a different bank account, you will not be tempted to spend it. And slowly build that money, have that some amount of cushioning for yourself. Like before, even if you say want to start something of your own, or anything for that matter, having just building some liquidity from where you can just take care of your expenses if there are certain variations, having some emergency fund built in there, because these are basic things before you can actually go ahead and start investing. Okay? Is that clear, or any follow-up questions or anything there?
No, I think it makes sense. I'll come back again. Next round.
I have a quick question there.
Sure.
You mentioned about emergency fund.
Yeah.
So how much should be a good amount for an emergency fund?
See, emergency fund is generally, so it depends on your situation. Generally, it should be something between 6 times to 12 times of your monthly expense. Okay, 6 to 12 times of your monthly expense, not income. Okay. And how do you choose if it should be 6 times or 12 times? It depends on your own, situation. The income that you are making, how stable is it? In a case where you decide to leave your job and move on to something else or start your own venture, or there are so many layoffs that are happening, if a situation happens wherein your income can be interrupted, in such a situation, when people are dependent on you financially, how many people are there who are dependent on you, and how critically are they dependent? Essentially, the risk that is associated with you. If it is higher, you should be having an emergency fund which is on the higher range of the 6 to 12 times. If not, having it closer to 6 times is good.
Okay, I'm just thanks for that question, Harshit, and for explaining, Ankit. I wanted now also pass it on to the audience. We're almost 30 minutes into the conversation, so if there's anyone who has a question or wants to come and just speak, share their thoughts, just raise your hands and we'll let you in. Into the call. Okay, moving on then. Bharg, so we've been talking a lot about, starting early, investing, all of that. So how are you or some of your friends actually investing? What are they doing to invest?
Yeah. So like a lot of me and my friends probably during during our undergrad, we had like small incomes, maybe like 2,000 a month, or maybe 10,000 a month, based upon like if you do a teaching assistantship or some side job, right? So we had a smaller amount of incomes. At this point, we had like so as high percentage return we get, it would be like very attractive for us. So even like a high 1% higher, or something like that. In that case, we used to start investing on our own without any advice on like discount broking platforms like Zerodha or Grow or something like that. But we used to just like put in money, which we read couple of news and then just invested, and then eventually learned it the hard way. But I lost my money, those small incomes that I had. So the question here to me is like, so these discount broking platforms would on an average give you like a little bit higher percentage of return, because the broking fee is not to be paid as in comparison to like a traditional broker. So like, how would you go about people starting off new to like, you start using Zerodha or Grow, to not probably fall into that trap of that small things, or probably use it in a better way? Like, what would you say?
So, Bharg, see, first of all, these discount brokers, these are good. I mean, as long as you have chosen a good one, particularly for the long term. See, when you're investing and based on your own research or an advisor's recommendation, you anyways need a platform to, invest from. And when you're investing via these discount brokers, it will help you reduce the transaction cost. But what people many times don't understand is that they are letting go of their brokerage, but that doesn't mean they're not charging you. There are no charges. First of all, even for these, when you're opening these accounts, particularly for students and people who are investing a small amount, there is a platform fees, a monthly fees or a quarterly fees that will be there that you need to pay. And particularly when you're investing in smaller amount, that may affect the return. So you should be mindful of that. But apart from the brokerage that which they have sort of let go of, there are other transaction charges. There is short-term, there are securities transaction tax, there is exchange charge, stamp duty, SEBI turnover fees, and of course, if you're making any profit, you need to pay taxes on it. Okay, so people who think that there are no charges on these discount discount brokers, and they trade a lot, they actually end up making losses because there are so many hidden fees. Essentially, hidden is not the right word, because when you get the transaction note, it clearly states how much you are paying in all these charges, but many times mentally it has not sunk in, right? Because but when you are saying okay, you're investing say via Zerodha or Grow, you think okay, these are discount brokers, I don't need to pay any fees. That is only for the brokerage. When you don't mentally, you don't have that understanding, okay, there are other fees that I'm paying. You may think okay, I can buy for say $1,000, sell for $1,000, buy sell. But the thing is, with every transaction you are paying a number of fees, and a lot of times people forget this, and he ended up making losses. And separately, so if you're doing this very often, buying, selling, you are more of a trader, less of an investor. And statistically, it's said that more than 80% of traders make losses. I mean, professional traders make losses. There's so much, of course, generally speaking, money is built over the long term. That is when you really make money. And these platforms are great for investing long term. Yeah, please go ahead.
Yeah. So what you said is exactly what I think I faced. That, the word discount broker was a little bit misleading to me, and then I didn't know about this hidden fees, charges, etc. And then I did end up making. So yeah, I guess I faced a lot of that stuff.
Right. That is why, just being aware of what's happening, and it's your money, so you need to be extra careful, right?
So,
Yeah.
Ankit, I think Bharg brings in an important point that nowadays there are so many apps and so many platforms, which are targeting me on social media, that I feel like I'm not doing anything. Like, I feel like everyone is investing and I'm just the one who's like, sitting at home kind of a thing. So, just want to ask someone else if they feel that way. Gaurav, do you get targeted because we are similar in age and stuff? Do you get targeted by like all these apps and platforms to invest?
I think not exactly. I would say, I mean, the startup apps, but definitely a lot other broking apps because eventually my number is out on MCA portal and other couple of more platforms. That makes me a lot accessible, which is not a good thing. I mean, I definitely get a lot of calls on a daily basis.
Yeah, I think we all do to take a loan or something.
So I know, and I would say that becomes a little annoying at times. And then what happens is that you somehow try to create an, I would say, subconsciously a belief system about it. And then you just prefer not exploring a lot more towards the investment or the industry overall.
Yeah.
Because there's already so much of noise and you feel that you really want to declutter yourself and focus on maybe other things. So I don't know, maybe that could be one trigger which is a negative from my side on this behalf.
Do you follow any influencers though? Do you ever feel the FOMO that is being like, of investing?
Not exactly. I would say, as you also mentioned in terms of my intro, that I am more curious about a lot of things. So for example, let's say when we're talking right now and I see, there's something very curious thought cross my mind. So now I'm going to go and research about that particular thought. So I would say I'm more of a person who is not driven by, let's say, particular topics, but then I'm more driven by the thought. So, for example, I'm watching a movie and I see, there's this guy, maybe an autobiography or something like that, and you feel, I really want to go deeper and want to understand more about this individual, the story behind it, and all of it. So that is how I am driven. But I really like, let's say, a couple of people around, and especially for youngsters, I would say Ankur is doing a good job because he's talking about why. So I believe before how and what, it is extremely important to go deeper and understand that why investment is important overall. Because once you know why, I'm sure a lot of people who are curious can figure out how and what.
How about someone else? Harshit.
Just to point on what Gaurav mentioned. So I think you're referring to Ankur Variku, Gaurav?
Yes.
Yeah, so he's the person who, I read his post once and then he was talking something completely different. And then when the market shattered, so he was talking completely different. So that's the challenge, because these kind of people have their own narrative at times, but they switch platforms and they switch side as per their will. And you cannot be very sure about what they are speaking and how much truth is there behind it.
Yeah.
Oh, yes. I remember the FD thing, no? Never do an FD. Do whatever you want. And then it all came.
And then when the market crashed, he's like, everyone should invest in FDs.
Okay, so I'm going to move away from this controversial topic because I don't want this to be like a session where we talk about a person specifically. But I think in general, yes, the point is that people do say one thing and they say something else. So it's important to follow the right people and know what they're saying. And Gaurav, I think it's great that you do your own research. I think Ankit mentioned that as well, that you should check for yourself. How it is. But Ankit, I just wanted to know, a lot of people follow this advice online, that Harshit just mentioned, FDs. So what do you say to people, who are listening to this and feel like I have to buy this financial product or I have to do this thing?
So, the thing is that nowadays financial products are also being sold like retail products. So something like, saying, okay, this is a limited time promotion and if you don't buy it now, you will lose the opportunity. Now, consider an example wherein, there's a mind-blowing once-in-a-lifetime offer going on women's jeans, from one of the top brands. No matter how good the offer is, no matter how good the product is, I am not going to buy it for me, right? Because I'm a man. I can't wear a women's jeans, right? So you need to understand the same, for financial products. First thing, you need to understand that there are so many products out there. Ash was mentioning, a few of them earlier. Now, most of these products, not all, most of these products are good for someone, not for everyone. A jeans, that great jeans can be good. I mean, of course, it can be very good for women, but men can't buy it, right, for themselves. Similarly, I see a lot of people, who invest in PPF, Public Provident Fund. It was good for our previous generation. it's not good anymore. It's actually pretty bad for our generation. People need to understand this. And then similarly, I mean, there are products like ULIPs which are just bad. I mean, bad for everyone. So you need to understand which product, financial products, which instruments make sense for you. And if you can't do it yourself, it's best when things are getting serious, when the investment amount is becoming bigger. It's better not to just experiment with random products कि चलो ठीक है थोड़ा सा ये भी खरीद लेते हैं. It's better you ask someone who's actually doing it. If you can ask someone who's there. Otherwise get help from someone who can actually guide you in a way after understanding what is relevant for you, not just giving you generic gyan.
I just want to kind of move the conversation a little bit forward. So we've been talking a lot about the basics, right? Now, let's say that there are some people who are investing all of that. I want to ask Harshit now, as someone who is an Indian living abroad, what are some questions that come to your mind when you talk about finances?
Thank you for bringing that up, Medha. So basically, I do invest in, say, US market, European markets through one trading platform. And then I wanted to ask if there is any possibility for NRIs living outside that they can invest in India, because again, Indian market is also growing much faster and doing some good work there. So how? So there are two questions basically. So first is how, and the second is if again, like there are the time differences and everything, so I won't have too much of time on a day-to-day basis to look at how my say whatever I have invested in is actually behaving or say performing. So what are the different kind of securities that I should invest in?
So Harshit, in terms of how, so you can have Indian account as in NRI. You can have NRE or NRO account. You can open Demat account or mutual fund investment account, and you can invest from there. Okay. When it comes to what you mentioned, you wouldn't have a lot of time to watch it day to day. So as an investor, you are a long-term investor. You're not a trader. So you don't need to watch it every day. Okay. And when you don't need to watch it every day, even if you don't have time to do it on a very regular basis, do your research, find the investments, and then you can find where to invest that money, and then leave it for the sort of from the mindset it should be for the long term. Okay. One thing that you should be aware of, particularly if you're investing, so whenever you're investing cross border, okay, be it Indians investing in the US market, Indians like people who are living in India, investing in the say US market, UK market, or others, or when say NRIs are investing in India. So whenever there is cross-border investment that is being made, you need to understand that two aspects which is going to impact your actual return, your total return. First is the return that you would be generating in the market. So say Indian market is up 10%, 15%, 20% or down. US market is up 5%, 8%. That is one aspect of it. The other one is the impact of movement in foreign exchange. So whichever two currencies are involved, say from India to US, it is USD and INR. That rate is also very important. Now, in terms of Indian market, recently I was reading reports from Bloomberg and IMF on major economies, and that says that there is 0% chance that India will go into recession. And among these major economies, India is expected to have the highest GDP growth rate. So India is definitely a great market to be in. US has already grown pretty well. And by a lot of people worldwide are saying now next 5 to 10 years is going to be the time for India, like Indian market, and that is where you should be if you want to generate good returns. Now, we were earlier talking about FOMO. Medha mentioned about it. So there are a lot of platforms in India who are promoting that you invest in US market. India, US market is kind of already done and dusted, and India is where you will be able to make good returns. So even say you are in UK, right? Similarly for you, like if you want to invest in India, that is where you will get the best return. I mean, among major economies. Now, the impact of forex. So, Harshit, if you're thinking of you're investing from US, from UK, you're sending money to India, you invest here, you get your return, whatever return is. There are two options for you. It's like either you can take the money back to London, so that take care of whatever goals for which you were investing. Other is, I mean, for a lot of Indians, they leave money in India so that they'll retire, or at some point they'll come back to India, so that money will be used. So the impact of forex may not be as much for you if you're not moving money back. But for say Indians who are investing outside India, today, US to USD to INR is approximately 82. So USD is around 82 rupees, and by a number of experts, it is expected that by the year's end, 2023, the exchange rate will be something like 78ish. So that is a 5% difference. So if someone is investing from Indian market to US market, and US market is giving you say 8% return, you need to reduce this 5% impact. So 8% minus 5%, your real return that you actually get in India is 3%. But for you who's investing from say US, instead of US market, you are investing in Indian market, and you're making 10% return in India, that 10% will get added to the 5% benefit that you will get by strengthening of rupee. And India is in a very strong position as of now. It is expected to grow. So stock market is going to go do better, and along with that, the currency, Indian rupees, that is also expected to get stronger. So India is a great place to invest in, both for people living in India and people like you who are NRIs.
Bharg, also take note, since Bharg is going to
also
start.
take note. You soon start making some really fat checks. You'll start getting. So you should also consider.
I have written it down.
Great.
I wrote it down. Yeah.
Ankit, I have a question on similar lines. So
Yeah,
you
please
talked
go
about FOMO, and I felt that especially during COVID times, a lot of people kind of jumped in terms of share market, crypto, and I believe it all happened out of FOMO, that let's say my friends are doing it and I should do it as well. I don't know, my understanding says that whatever game you play, be it let's say angel investing or any kind of other investing, it is important for you to know the game. So what is your thought in terms of, let's say, people who are driven by FOMO, and it's not just like the competition or the companies driving the FOMO. I'm saying it's the community or social dynamics of the society driving the FOMO.
So, Gaurav, there is a famous saying in finance. Before I say that, just quick few explanation. Bulls are people who think that the market will go up, right? Bears are people who think the market will go down. So in finance, the world of finance, there is a very famous saying: bulls make money, bears make money, pigs get slaughtered. Pigs are the ones who have no clue what's happening. They're just randomly following the herd. So coming back to what the specific incident that you talked about, market fell in 2020. Okay, people were scared to invest. A lot of people actually took money out after the market fell. But smart investors, seasoned investors, they were the ones who were putting money in the market around that time. So that, along with a number of other factors, the way the government was supporting the market, and many monetary policies that were announced, market recovered, and it recovered fast. So by December 2020, it had already recovered quite a bit. Now that is when people started getting FOMO. Okay, I should also invest. Market has already, market is running, has given such amazing return, almost doubled in like 7-8 months from the low. And people started, and a lot of new investors started getting into the market. In January 21, it witnessed highest number of demat accounts. 80 lakh demat accounts were opened in January 21, and these accounts are opened, which means these people did not have an account earlier, most of them, and these people started investing in January, and market fell in February. It recovered a bit, and then again fell more in April. So when you're blindly following the herd, it is very difficult to actually make money, because you would be getting into the market when returns are already done. When everyone has already invested, markets have, the opportunities are already gone, markets have already risen. So there is little room for you to actually make money. So if you follow the herd, you will always be behind, right?
Yeah.
Gaurav, I hope that answered your question.
Definitely. Thank you for clarifying it.
Okay, so yeah, just it's important not to just blindly follow the herd, and if you want to make some real return, some real benefit, you have to do that research on your own.
So I think that's an interesting
Yeah,
point.
Harsh, you were saying something.
Yeah, Harsh, please go ahead.
Yes, so I'll just refer to one of the points you said a little while back, right? Like just related to it is that report that said India had a 0% chance of getting into a recession. Again, right? Like among the FOMO and too much information which is out there, can you share some of the trusted sources of news that you follow personally? Because there's too much out there, right? So if you can recommend a few places where people like us should look at to find some reliable information.
Sure. So see, again, I generally follow and have subscribed to a few of the good news houses, media houses of India. So, say Economic Times. That is something that I read. I read Forbes. Uh, I invest regularly, and I invest and of course, because of my startup, I follow market very closely. So I also follow Money Control for news, as well as for my own research. There are a few other platforms that I also use, but use one of these relevant and established media houses. Now, unlike the influencers who can go back and forth on their words, or many a times, they have the option of just, so they suggested something 3 months back and now that's not relevant, or something opposite is supposed to be done, or whatever they suggested doesn't hold any ground, they may just go and remove their post. But you are the one who followed that post, put in your money, and you are the one who's going to see the impact, right? So whenever you are listening to anyone, do your research and use these established media houses. I hope that answers your question, Harsh.
Yes, it does. Thanks.
Cool. Mita, you were saying something.
Yeah, no, I was actually going back to Harsh only because, Harsh and I were talking. So, Harsh, you had a question about, when to exit and, how to enter the market, right? So, I think now is a good point. Now is a good time to ask that question since you were just talking about, how the markets were performing.
Yeah, sure. Thanks, Meda. So, yeah, I mean, one of the things is I personally face is I can invest into a lot of instruments. Like, if you see my mutual fund portfolio, I would actually have 7 or 8 of them, right? And many of them have very similar stocks in them, right? So maybe in retrospect, I feel I could have only invested in one of them instead of just putting in money in 2 different fund managers. I mean, there could be different dynamics, but what is more important is I actually also saw a couple of my mutual funds which gave me good returns earlier, but now are going down, right? And then I am in a fix whether I should take out money or whether I should put in more money at this time so that if at all it goes up again, I make more returns, right? So exiting a typical, instrument wise, what strategy could be followed, whether it's a mutual fund or a stock, if you could help there, so like something on those lines,
Sure.
like when to exit, what instrument.
Sure. So Harsh, first of all, before exiting, when you're investing, you should be aware why you are investing, and so whatever the purpose is, whenever that purpose is met, you can withdraw your funds. That is a good point to exit. Okay. And of course the purpose can be it can be short term, it can be long term. In short term, generally you shouldn't be taking much of risk, so when you are withdrawing, whenever this purpose is met, you can withdraw it, and it should be good. When you're investing for the long term, the dynamics change. There are a number of other things that come into picture. The portfolio should be built better. The portfolio, it should be diversified. The asset allocation should be done properly, and it should be aligned to your personality, or your risk profile. Now, when you have invested for the long term, say you want to make a purchase or whatever the goal is, say, and you need the money in say 5 years, 7 years, 10 years, so long term, markets will move, right? So as you were saying that there are few funds who were doing well earlier, but they're not doing particularly well right now. What do you do? There is a concept called portfolio rebalancing. So at times when parts of your portfolio, certain types of assets in your portfolio, they have done well, So suppose your overall investment, your overall portfolio should be divided between two types of assets, 50 and 50, and one portion, say equities, that went up and the proportion has become say 60-40. Okay, that is when you should be rebalancing it. That is when the market is up, so equity is up, you should be selling it then, but not all of it. Just sell it, because you never know if it will go further up or not. To your point, whether if it is going up, should I invest more or should I exit? Right? So just again, maintaining a balance there. You shouldn't be exiting all of it. If it is for your portfolio, if it is, it shows that it has a higher proportion, higher allocation, you should be selling that excess proportion. So sell that 10% and bring the 60% back to 50%. And the 10% that you have sold, it should be going to the funds or the assets that you invested, which did not give that much of return. Of course, that overall it should still be a good investment, but asset class wise, that is where you should be putting money. Because all of us have heard, okay, you should buy cheap and sell more. But how do you do that? And how do you know if it is cheap now, it won't fall, and if it is expensive enough that you should be selling it now? And there is no one who can predict this. Having an approach, having a systematic, mathematical approach is going to save you here. I hope that answers your question, Harsh.
Yes, I mean that 50-50 thing was very interesting thing. Thanks, Ankit.
Yeah, so that is called portfolio rebalancing, and generally you would have heard that higher the risk, higher the return, right? Generally, portfolio rebalancing is one of the unique ways where you actually reduce your risk and you can increase your return. And generally speaking, high risk, high return works on an asset side, and on a specific asset. Portfolio rebalancing doesn't happen on the assets end or asset level. It happens on the portfolio level. Okay. If you are building a product wherein you will be able to automatically, you will be given prompts that, okay, so Harsh, this is a time, when you should be making XYZ changes. So we are working on that, and hopefully that should ease the concerns that people have, the investors have about their portfolio.
Okay, thanks, Ankit and Harsh. I am the official timekeeper, and I just realized we're just towards the end of the conversation. So this was super engaging, and I actually lost track of time a little bit. Final word to anyone from the audience. If you have a question and you want to raise your hand, this is your chance to do it. Because we're just kind of wrapping up this conversation now. We can talk endlessly about finances, but I just want to quickly, help the audience kind of summarize what we just had. So if everyone, Bharg, Harsh, Harshit, Gaurav, if all of you can kind of summarize and say what was your key takeaway, so that for the audience listening as well, they'll be like, okay, this is the point that was valuable, or they can take back. So if you can do quick.
Before guests say their own learnings and their key takeaway, Ram, we have Ram. He, I think, has a question.
Oh, perfect.
Ram, please unmute yourself and go ahead.
Yeah, please introduce yourself, and would love to hear your thoughts. Or you would have to unmute
Ram,
yourself.
Please unmute yourself. I think he's having some issue, probably technical issues. So Mita, please go ahead.
Yeah, so we can continue, and as soon as Ram can join the conversation,
we have another person, Chandan. He wants to.
Okay, perfect. Chandan, go ahead.
Please go.
Very good evening to all.
Hi.
Hello.
Hi, Chandan. Yes.
One thing I always face is retail investor like us. We read and we heard the cycle. The market is a cycle. You should invest in a down and exit in up. But we are not getting that point. Actually, just we started looking to market. So I thought that this is a low, but we just enter, we found that no, we are at the middle of the cycle. So in that point, I want some insight from you.
Sure, Chandan. So, market, of course, moves up and down. Cycles are actually defined more for various sectors. Okay, there'll be sectors that will do better at times. There will be and those sectors will do not so good at times. When it comes to the market overall, no one can predict whether you are in sort of bottom of the cycle, it will recover from there, or if it is middle or top. It's very difficult to say. Okay, and what I was just talking about, when you are making your investments, it should be a diversified investment, particularly when you're building it for the long term. And time to time, as market moves, because it will move and no one can predict it, when it moves, you need to make changes to your portfolio based on how the total amount that you have invested, how it should be invested or assigned. So various asset classes are there. So suppose you're investing 1 lakh, 30,000 is supposed to go in, say, equities, 50,000 is going in, say, debt, 10%, 20% is going in gold. You need to keep moving these because at any point of time, not all of these assets will move in the same direction by the same magnitude. So if equity market is going up, gold is most likely not going to do very well. Gold and equity generally move in opposite directions. So if you are incurring losses in equity, your gold will be performing well. Sell some of gold, okay, and buy equity from there, from that money. More of equity. Okay, just again the 60-40, 50-50 that I just mentioned about. This way you would, because no one can, as I said, no one can predict if it is the high of the market. If the say if you're talking about gold, no one can tell, okay, this is the highest point it will go. But whatever high it has gone, I am taking some profit off the table. I'm just booking some of the profit. And it's not that I'm selling all of it. If it goes up further, I still have investments in gold, right? Because I took only a small portion of it. And I use that money to buy equity. To buy equities, right? Because equity had fallen. I hope that answers your question, Chandan.
Yeah.
Oh, thank you. I'm going to move you to listeners.
Just to add on what you already mentioned.
Yeah.
So it's more like what I do is I make my own target that, okay, if I get £100 profit in any investment that I have done, I'll exit, mostly. So that also helps me to keep my portfolio in the positive side and not get too much of losses in any of the share that I have invested. So
but
it could be a good starting point.
But Harshit, the thing is that way you may lose out on opportunities, because when there are few very good performers, the companies that can give you great returns, it has only given you £100. It has the potential to multiply.
Loss will be minimized, right?
So what is it that you're targeting when you're investing? What is the aim? Is it to minimize the loss or to maximize the gain? Right.
Like
So taking some,
basically. Yeah.
So particularly, when you're taking some money off, removing some money is fine, but not you shouldn't be exiting all of it. If it is still a good piece to invest in, a good share to invest in.
So this entire concept, actually what Chandan and Harshit were also referring to, is portfolio rebalancing, right? So if anyone is interested, definitely go and read more about portfolio rebalancing. We've also done a couple of videos on this, so you can check it out on Ankit's profile, how that works. Now we've kind of already overshot the time. I don't know if Ramnath is
I just want to call Ram again, if he can speak.
Yeah.
Ramnath, can you please are you able to unmute and speak? I think he's still facing challenges. So, okay, Mira, please go. Please continue.
Okay, perfect. So then we'll just wrap up this call with quick thoughts from all of the members that we have, right? So starting with Bharg. Bharg, what was your key takeaway from the call today?
Yeah, the first and the very most was that India is definitely a market to invest in. And once I start making my income, I will definitely consult either you or like a proper financial planner to like somehow route my money back to India. Second thing is the question that I had earlier is like how about financial literacy, like how much to know, how much not to know. It's like keep a balance over there, and then like balance is even much more important in like how much to save and how much to spend at the same point enjoying the life. So like all these three overall, sums up my key takeaways from the year.
Perfect. Thank you, Bharg. Harsh, do you want to go next? Quick key takeaway.
Yeah, I think Bharg covered a lot of them, but one interesting thing I noted down was I thought PPF was a good, safe investment. And when Ankit said it's not relevant, I have a lot of things to think about now. So, yeah.
This is so common.
This is
Yeah,
like the
sure.
key takeaway everywhere we go. Like everywhere we go, this is like, so we do sessions in companies as well. And this is always comes up because someone or the other is investing in PPF. So, thank you for, putting a spotlight on that, Harsh. Yes, don't invest in PPF, guys, if you're young. Okay, next, Gaurav.
Yeah, I think one thing which is I'm really grateful is that I never did invest in PPF. So yeah, but yeah, I think one key takeaway which Ankit recently mentioned that it is important that when we're investing, your focus should be about aiming big and maximizing the opportunity and not minimizing the loss. So for sure, that is the one major key takeaway, which is philosophical though, but yeah, it is.
Awesome. And Harshit.
So one of the two main key takeaways were emergency fund, how much and how you should plan your emergency fund depending on the risk appetite and the situation or say the stage of your life in which you are currently. And then the second is how an NRI can actually invest in India through DMAT and NRI NRO accounts. So yeah, those are the two main takeaways for me.
Perfect. I just want to thank, firstly, all the listeners who have been with us for the last hour. Thank you so much. We really enjoyed talking, but I hope you enjoyed listening to us. That is very important, and I hope you learned something. I want to thank Bharg, Harsh, Harshit, Gaurav for being part of this conversation, and for Ankit for hosting this entire thing. Thank you so much.
Thank you so much, everyone, all the listeners, all the guests. Really appreciate your time, and you are with us even past 9. So really appreciate it, and special thanks to all of you. Thank you, everyone.
Absolutely. Thank you. Have a good evening. Have a good weekend. And be financially smart.